This conference will now be recorded.
Good morning, everyone. Welcome to our first quarter 2026 economic update. As usual, last quarter wasn't boring. We hope to give you a general overview of the key issues impacting the United States and global economies. We're focusing on the areas that will impact most of our attendees. Please note your questions in the chat box. There will be ample opportunity in the latter part of the presentation for us to answer those questions. Thank you. Several of you have submitted questions in advance, and we'll address those when we begin the question portion of the presentation. Well, let's review a quarter when I think we got more questions than answers. Joining me today is my partner, Shawn McCabe. Together, he and I will strive to help you make some sense of the economy and the stock market. Shawn, help us out.
Good morning, Marshall. Good morning, everybody. Can you hear me okay?
Got you good.
All right, fantastic. During our last economic update, I had mentioned my vision board. It's the new year, right? And my vision board word of the year was signal. I'm glad I chose that concept or that word. There has been plenty of noise to cut through so far this year, so we're going to help you focus on the signal this morning. The only change we made to the noise list, if you will, over the last quarter was we dropped AI, artificial intelligence. It's still out there. There's still plenty of noise around it, very prominent in the headlines, but not much new unless you were looking at earnings last night. But there's a lot of other things to cover this morning, so in the interest of time, we took that one off the list. And Marshall, I think we're going to switch it up a little bit this morning. I'm going to kick it back to you, if you don't mind, to give us the general market update.
Got you covered. Thanks.
Cool.
Well, many of you know I periodically assist as a resource for mainstream media. I know I beat them up all the time on our presentation, but yes, I do participate with them as a financial professional resource. They frequently refer to days when there is only one major story and everything else tends to take a back seat. Well, this quarter measures up to that scenario. The story is the war in Iran and its domino effect on oil prices and thus the various world economies. Shawn and I are going to do our best to help you make sense of it all. Sometimes I hate being right. When we had our annual economic update, I commented that I didn't know what would trigger the next shock to the market, but knew there would be one. As if on cue, the first quarter of 2026 delivered a market shot stemming from two unexpected sources: doubts about the previously invincible artificial intelligence boom that Shawn had reviewed during the annual economic update, and the war in the Middle East. We know that historically, 3 times a year, the market goes down 5%. Once a year, it goes down 10%. Every 4 to 6 years, we get 20%, and so on. Volatility isn't a bug. It's the toll you pay to get rich. It's the toll you pay to gain wealth. Now, no one can predict how AI or the war in Iran will ultimately play out. And it's impossible to base an investment policy on these complete unknowns. So rather than reacting to current events as stock traders do, investors focus on their long-term goals. So unless your goals change, your plans won't change, and neither should the core holdings in your portfolio. When the war ends, oil will resume flowing freely in the Middle East, gas prices will decline, and the world will hopefully be a little safer. More importantly, what's gone on recently? So I have this screenshot for you, and as you can tell, this was taken yesterday at 12:59 p.m. So 1 o'clock yesterday. What has happened to the market since January 1st through literally lunchtime yesterday? Well, you see the 3.99% increase. So in 4 months, plus or minus a day, the market's gone up 1% a month on average. Now, we all know that's not quite the thing. So if you had ignored the market completely for 2026, the S&P would have given you a 4% return. But as we all know, you probably did not ignore the market. Well, let's look at from this crisis time, as I'm going to refer to it as, like most of us, you were probably watching the market, hopefully not via the mainstream media, and you were not enjoying the impact on your portfolio. It's no fun when you're dropping and you see that 6,300 in the S&P back in March. That's painful. As is generally the case around the bottom of the trough, I receive a call from a client who's experiencing this for the first few times. Always a different client, but it's just, again, right on cue. This client was wanting to sell their whole portfolio, go to cash, and in their words, wait until the world economy settles down. Well, we've got some pretty astute investors on this call, and I challenge each of you to search through your investing history as to when the economy was settled down. Well, using my tax hat first, I discussed the tax ramifications of such a move. Giving up about 20% of his gains in the portfolio in taxes with no hope of ever getting them back just wasn't a favorable option. Donning my financial advisor hat, we reviewed their financial plan. The fact that they don't intend to touch their investments for many years, and then reviewed their holdings and the anticipated impact of a prolonged war in Iran. The following are not recommendations to buy or sell. They're presented for information purposes only. We discussed the brand of cell phone they own. We discussed the brand of detergent that they use. We discussed Charmin and how it performed during the COVID market decline. In short, as an investor, he agreed the best yet unpleasant course of action was to stay the course. As you can see from the slide, doing nothing the last month resulted in an almost 12% increase in the market. Let's take a longer view. The market is still batting 1,000. Though through every global, domestic, and economic crisis, it has still recovered and gone on to new highs. Shawn, tell us about the energy issues. You get the headline story. Go for it.
Definitely a headline story. We actually been talking about this since the beginning of the year. Last quarter, Marshall and I reported that energy or oil is the biggest contributing factor to economic progress or slowdown. I'm not saying we had any idea what was coming up here, but it is something we touched on at the beginning of the year, looking at $60 per barrel of oil being the sweet spot. And up until recently, oil has been quiet. I referenced the TV show even last quarter, TV show Landman. I think a lot of people have been watching that. Very good show. But oil markets right now feel like Saturday Night Live cold open. Every day there's a new plot twist, and somehow gas prices are gonna kind of be the punchline. So unless you followed our turn off the news advice to a T, you should know about the Iran war, the Strait of Hormuz, and the resultant supply issues driving up oil prices, which is creating a lot of the volatility in our equity markets. This may be a bit speculative, but something less talked about is the underlying shift I think is coming in how the oil markets and prices are controlled. First, in recent years, the U.S. has become a net exporter of oil and really darn close to energy independence. I believe we still import some oil from Canada. Second, the UAE just announced, United Arab Emirates just announced they are pulling out of the global oil cartel, OPEC. I believe that headline came out yesterday, maybe even the day before. And that pullout is effective May 1st. They're moving swiftly. Doesn't affect anything right now because there's no oil moving. So they're kind of slipping in under the radar. And when this whole Hormuz thing in Iran tamps down, the UAE is not part of OPEC anymore. With that and together and amongst other things, I believe this signals a fundamental shift towards a more free market economy, meaning the free flow of prices of oil based on competition. I think it'll lead to lower oil prices and some more short-term volatility, of course, as market competition will drive prices lower, and I believe it'll be more consistent. We'll need to keep a close eye on it, and we will. With all that being said, understanding the oil markets and its impact on the economy really still boils down to very basic economics. So let's take a look at it. First up is demand, supply, and price. I know it's simple and possibly boring, basic economics, but it's really the best way to assess oil. So let's move on to the next slide and look at demand. In short, when prices increase, right, basic economics, prices go up, demand usually goes down. People don't want to spend that much for it, which results in an increase in supply, especially with oil, right? And until production is decreased, allowing everything to catch up. Kind of sounds like a game of whack-a-mole, doesn't it? And it kind of actually is when it comes to oil. All this can be seen in the currently reported figures in the chart on this slide. Taking a quick look at the chart above, looking at the 25 and 26 years, we can see global production, the top half of the table, is still slated to increase by 700,000 barrels per day in 26 over 25. While consumption, looking at the bottom half of that table, is slated to increase 1.3 million barrels per day in 26 over 25. So it may be glaringly obvious here, but with an increase in consumption greater than an increase in production, inventories, aka supply, are slated to decrease by 500,000 barrels in 26. Forward estimates, though, continue to show an increase in production, even with a decrease in consumption. Hence the increase in supply that you're seeing on that chart above in 2027. How realistic is this? I mean, we're looking at the headlines news right now, and we're seeing oil prices over $100 and something a barrel. We've seen spikes all the way up to, like, I think 126 at a peak. Don't know how long this war is going to last with Iran and whatnot. But remember, I just talked about the UAE leaving OPEC. The U.S. being an exporter, Venezuela, the only South American OPEC member, by the way, is now controlled by the U.S. The rest of South America does not participate in OPEC quotas. And finally, the Strait of Hormuz. It is a choke point to about 20%, maybe 21% of the world's oil. It will eventually reopen. It has to. All of this signaling, in my opinion, the flow of oil will be like a tidal wave once all this dust settles. With that, we are simply left with, what does this mean for prices? So oil setting around 103. I didn't check it this morning. It was about 103 yesterday. I think it's 101 today, which is well above the $60 price per barrel target the world has really gotten used to. Economies operate on that. We like that at the gas pump. People have planned around that figure. So when it gets to that $103 a barrel price, demand drops. It is what it is. Considering energy's influence as a component of inflation globally, the correlation of higher oil prices and shocks to the stock market are one of the clearest explanations of stock market volatility I've seen in a while. Oil prices go up, people get worried about inflation, people get nervous, start pulling their money out of the markets, and then you have the volatility of the market. So I want to distill this down a little further to what does it mean for you? Last quarter, we mentioned during this portion of the presentation that geopolitical risk in oil is high. It always has been. I have the same sentiments this quarter, but I'll add to it. I don't think high oil prices will be persistent. As soon as the Iran conflict resolves and the Strait of Hormuz reopens, the fears of higher oil price persistence, I think, will subside. The flow of oil from the Middle East will flood the market. OPEC will have a little less overall control. Granted, they still do. It's mostly Saudi and their partners. And we'll see a substantial decrease in the price per barrel, but certainly not without volatility. We're literally one tweet away from seeing $75 barrel price per oil. We've seen it. So that's kind of the story behind energy. And we're going to talk a little bit about that throughout the rest of these slides, and you kind of see how this plugs in. So diving down a little bit further into the economic update, I want to look at I said diving down, I mean kind of broadening out, looking at the broader market. Let's take a look at the general economic conditions. Our top four dashboard indicators, if you will, we cover these every quarter, is growth measured by real GDP, inflation, where are we at with unemployment, and kind of the Fed's policy, Fed funds rates, their overall stance on where they are with interest rates. So taking a look at real growth, real GDP, sorry, I lost my words there. This morning's release showed up at 2% for this quarter, Q1 26. Shows a little less than the average for all of 2025. And I always like to put the historical perspective. What do these numbers actually mean in comparison to where we were before, what we are historically, and on the total average? The historical average of U.S. GDP from 1947 to 2024, probably need to update that now that 25 is done, it runs around 3.2%. The fact that we're seeing 2% kind of start seeing, all right, we're not growing as hot as we can or we have in the past. But one thing I always like to look at is what's making up that GDP? What does that number consist of? And to make sense of that, we like to look at the underlying makeup of what's contributing to it. Even though the latest report came out this morning, it printed the 2%. Obviously, we haven't had a chance to dig into what the makeup is, and everything kind of lags, especially the government shuts down. We're probably going to say that 3 or 4 times this presentation. The latest underlying data that we have of GDP was as of the end of the year, as Q4 25. And when looking at it this way, it kind of makes sense why GDP this quarter is slightly lower. And looking at the bars there, I know it's really hard to see on this slide, but the green bar is actually negative. We had less government spending this quarter by about 1%. And then what contributed to the growth this quarter was consumption, about 1.3%. Let me rephrase this. This was fourth quarter. So looking at that, the government spent less, but consumers are still spending. That print will come in at around close to 2%. I imagine the same underlying information will apply to the 2% we're seeing this quarter. All that to say, not too bad. All in all, not a terrible report for Q1. Next up is inflation. How are we doing on inflation? The consumer price index measures the average change over time in what consumers pay for a standard basket of goods and services like food, housing, transportation. The latest report shows a 3.3% year-over-year increase from 2025. So we're seeing a bump in inflation. And you guessed it, it's coming from none other than energy, oil. Yep. It's worth noting that the core CPI, if you take out food and energy, we don't usually talk about this, it just kind of confuses things, was only 2.6. So we're seeing a pretty substantial part of that be related to energy. And as always, looking at the historical average, our historical inflation rate runs around 3.2. And then the Fed's goal, one of their mandates is keeping inflation in check at 2%. So we're above the Fed's goal and we're slightly above or right at our historical average. Nothing to be too concerned with yet, but definitely one of those early indicators we want to keep an eye on. And just like GDP, what does the mix look like? And again, there's no way you're going to be able to look at this slide and kind of pick apart what it is. So I'll explain it to you. But just like GDP, like I was saying, what is making up that inflation? And you might notice on this chart, it's really two things. It's the dark blue line and the light blue line. The story is still the same this quarter. Consumer spending, which is the light blue, is contributing a substantial portion of the increase in inflation year over year. And then the dark blue component, housing, one of the largest components driving inflation. That has been for many years. So looking at those two things, housing's getting more expensive and consumers are still spending. When demand goes up, pushes price up. So you got your dining, your recreation, and other services that consumers are spending on. In my opinion, consumer spending being part of inflation is a good thing. Consumer spending contributes to GDP. People make more money. Economy does well. Market does well. Companies make more money, so on and so forth. So let's move on to help wanted. Unemployment has remained mostly unchanged since last quarter. In January, we saw 4.3 running from month to month. February was 4.4 and March was 4.3. So we average those together and we see a 4.33% unemployment. I think what you'll see in headlines is around 4.4. Reality is it hasn't budged. Historical unemployment averages around 6.25%. So we're substantially below our historical average. And the Fed's second mandate is maximum unemployment. So, if we look at the average, we're well below that. Can kind of see why the Fed may have paused yesterday, probably also part of some political factors, but that's just conjecture at this point. The Fed funds rate, speaking of the Fed, they just nominated, or I guess sworn in, Fed Chairman Kevin Warsh. And I believe the position to not move rates was, mostly quiet due to the mostly quiet economic indicators. Uncertainty, the Iran conflict. It makes sense the Fed maintain their position on monetary policy, which remained unchanged. So we're still floating between 3.5 to 3.75 with the current effective rate sitting at 3.64. So nothing exciting to report there. But kind of talking about nothing exciting, which is kind of exciting, right? Because consistency or uncertainty, really, I'm going to rephrase that. Uncertainty is what freaks the market out the most. Even the Fed Open Market Committee board members are kind of thinking the same thing. This plot, the dot plot, kind of hard to read the numbers and all that, but just kind of gives you a visual of each dot is one of the FOMC members' opinion on where rates should be. The first column is where they see or foresee the rates going for 26. Second column's 27. Third column's 28. Fourth column past the line is just a longer term run, and you're seeing the rate, at least the FOMC, who controls the rate for the government, somewhere close to that 3.5, 4, somewhere in there, kind of right where we're at. So I don't foresee much change. I think Kevin Warsh is going to inherit it via a smooth transition. Let me leave it at that. And then what also is kind of a very much leading indicator of what's going on and maybe what could be coming around the corner. This is kind of the early warning lights on the dashboard. This is the yellow lights that pop on is consumer confidence. I know we often look at the consumer confidence index. What it is, it's a survey of how consumers feel about the economy. And the measure of this thing starts at 100. That's a neutral outlook. Below 100 is a negative outlook. We don't feel good. We don't think we're going in a good direction. And above 100 is a positive outlook. Hey man, we're making money, everything's good, inflation's in check, and we feel good. It's a feeling index, if you will. Often this index is used, like I said, as a leading indicator because roughly 70% of GDP is consumer spending. So when consumers have a largely negative outlook on the economy, and when I mean largely, I mean in this index, less than an 80 on the index, it could signal a consumer behavior is changing, and usually consumer behavior changes show up before it hits the data in GDP. Early warning indicator, kind of want to point that out. But this is why there's often a disconnect when you see consumer confidence is in all-time lows, but the market's still feeling good and the market's performing. All that being said, with an index reading of 91.8, which was a nice tick up from what we saw back in December, consumers feel better than they did last quarter, but are still a bit negative on the economy because we're not at that 100 yet. I'm pretty sure gas prices and higher, that sticky inflation that happened during COVID that stuck around is still causing some of that sentiment. I wish I had some more updated news for you, but our government still has got some shutdowns going on. They're still trying to figure out what they're going to do with that. That being said, the LEI, the leading economic indicators, they get a lot of their data from BLS. Their data is a little bit behind, so we haven't gotten the latest prints on these. But it's showing slight declines, obviously because of what we're seeing in the softening GDP, probably where it's coming from, the sticky inflation. But nothing we haven't already discussed, and in my opinion, no real concerns as of now. So to sum up my economic outlook, or our economic outlook, had a little fun with this one. I asked ChatGPT to provide me an image representative of today's economy. That's all I asked it, and this is what it provided: a bull walking on a tightrope, presumably the market return chart. You can see where it's headed, right? I thought it was funny. I couldn't help but laugh, and now I'm sharing it with you. Hope you got a laugh out of it. While chat portrays quite the chaotic future, probably not too far from correct, I think we have a lot more clarity for now. GDP came in at 2%. That's a little softer than what we expected. But we saw why with less government spending, which I could be argued that's not a bad thing. Inflation has ticked up, easily understood why. Most likely, this word is great, transitory. They're throwing that around like crazy right now, which I think could be synonymous with temporary. When the Iran-Florida conflicts, and if you relate that to oil prices, that's what I mean. It could be temporary, transitory, related to oil prices. And that Iran conflict war ends, and also with consumers, feeling better and consumers still spending, I don't see a big issue there. Unemployment does remain low, and by any long-term standard, it's low. The Fed is calm. Rates are still meaningfully low. Consumer confidence is actually increasing, usually leading to more spending. Consumers feel good, they spend more. And no significant move in any of these underlying economic indicators. So feeling pretty good about things from a data perspective. So as long as things play out in the oil markets as we expect, We hope to see more stable economics over the short run, with the standard caveat, unless something changes or a mean tweet hits the internet. All right, Mr. Gunn, I think that's enough for me for now. I believe that about covers it from the U.S. economic standpoint. What are you seeing in the world of geopolitics? Pun intended, by the way.
Well, geopolitics is fun. Next time we have our pre-production meeting, we're going to take a vote on who gets to do this. This is the crazy portion. We'll
Yes,
start with Russia versus the NATO, U.S. versus NATO relations. I'm going to just a quick show of hands before I hit the next one. How many of you are aware that in this week, this calendar week, Ukraine managed to bomb a Russian refinery over 1,000 miles from the Russia-Ukraine border using U.S. Manufactured armaments? No hands went up. I'm not surprised. The reason I cover that is because, yes, that is real. It did happen. But remember when every play-by-play that happened in the Russia-Ukraine war was on TV? And think back to when the last time you probably heard or saw anything on TV about Russia-Ukraine battle. The point of me saying that is that we have these geopolitical tensions that are going on constantly. And when one takes the front line of headline news, we see the reaction to that in the marketplace. But in the reality, that's a temporary, I'll use Shawn's word, noise that doesn't relate to the long-term growth of the market. And sometimes that noise can cause a dramatic decline in the market that then follows a dramatic recovery. But it's all part of what we go through. Iran versus Israel. Interesting in here, Hamas and Israel appear to be peaceful for the moment. As you know, I speak regularly with one of my clients in Israel, and he recently told me the concern is more Iran than the Hamas, but Israel is always on the alert for attack. It seems like that goes back 2,000 years or longer. The U.S. and China relations are in full economic war using tariffs and, of course, the Iranian oil. But at least they're talking. It seems the rhetoric fluctuates almost daily. U.S. and Denmark, that was a biggie back in January. Those relationships have taken a back seat to the Iran war. Don't be surprised when this comes back to the forefront in the not so distant future. U.S. and Venezuela are trying to figure out the new Venezuelan order. And I'll jump ahead and break in right here. We had someone in the chat room discussing about the Venezuelan oil and the impact on oil prices. Keep in mind, Venezuelan crude isn't really that great. If you tried to bring the Venezuelan crude into the U.S. and turn that into gasoline, probably not going to happen. Their crude, their oil is more designed for heavy crude items such as asphalt or not cruise ship, but industrial shipping use. You probably would never see Venezuelan crude be refined enough to get to the pump that you're getting ready to put in your car that you want to put quality gasoline in. So it has the key for controlling Venezuelan crude is that one of their largest customers, if not their largest customers, is China. And so controlling that Venezuelan crude means you get to control the flow of oil to China. So it's not exactly getting the crude to drop the price of oil, it's controlling who gets it and when. So that's a little interesting. But the political aspect in Venezuela is another story. And melting those into what is the new norm in Venezuela is still tense and things we will follow in future updates. I put Cuba on here. I'm just going to introduce this as attention with follow-up at future updates. We'll talk about that in later quarters. But as I planted the seed on the Denmark relationship, I'm planting the seed with the Cuba relationship so that I can turn around in 3 months or 6 months and say, hey, you heard it here. So lots of tense areas globally. I suspect this will continue through the remainder of the year. There may even be new opponents that we didn't foresee. So stay tuned, please. U.S. politics, yes. Here we go again. Another quarter of headlines that seem as concerning as ever. The partial government shutdown that began February 14th continues, and there isn't an end in sight. The shutdown is hitting the Department of Homeland Security, DHS, which supports airport security, disaster relief, coastal safety, and other national security measures, including immigration and customs enforcement, affectionately known as ICE. House Speaker Johnson floated changes to an already approved Senate bill that would fund all of the departments except for ICE and Border Patrol. Congress is still unable to reach a bipartisan agreement after more than 2 months of discussion. President Trump said he wants a bill on his desk by June 1st. So we got a month to go. There will be a bill to get things reopened. So how do you get a bill passed? You give any holdout votes you need pork for their districts and pet projects. Congress has been doing this ad nauseum for decades. It has become the normal course of how we get things done here in the US. The result will be more spending, no real cuts, and an increase in the deficit, or business as usual. Oh, and I'm thrilled to remind you that it's an election year, so we'll have plenty of volatility in the third and fourth quarters. So before I dive into the data, I just want to give you our best advice on long-term investors, and that is to turn off the TV, hold steadfast, and stay the course. Shawn, talk to us about taxes, a more pleasant subject.
Yeah, I figured we'd pause the regularly scheduled broadcast and take a break and talk about taxes. And especially now that we just wrapped up tax season, great season for Marshall and I, and thank every one of you who are our tax clients. But hopefully many of you saw bigger returns. I know we did for a lot of our clients, or even less amount due as we began to settle into the first year of the OB3 tax provisions taking effect. I think it's worth touching on some of the key provisions just as a final reminder here. So the first and foremost, the standard deductions increased. Single, you're 16,100. Married and filing joint, it went to 32,200. And then if you're head of households, 24,150. I bring those data points up just to illustrate. We used to be able to itemize at a lot lower figures, but once Tax Cuts and Jobs Act came in and put these in here, a lot of folks just do the standard deduction. So we've been locked in these standard deductions for a few years. One cool change this year, though, was the seniors now get that $6,000 if you're over 65,000 or 65,000. That's a lot of years. If you're over 65 years old, you get an extra $6,000 deduction, kind of part of that standard deduction, if you will. And that helped a lot of seniors get a lot of money back. Also, what helped a lot of folks who were on that border of itemizing or staying standard was that SALT cap increase, the state and local tax deduction cap increase. Moved to $40,000. If you earned over a certain amount, that cap was where it was at 10%. But we saw a lot of that impact us. So as you're thinking about things this year, keep those in mind. Something else I want everyone to kind of know about, it's a little bit of change in the charitable deduction options. Before, if you didn't itemize, you didn't get to take advantage of your charitable deductions. Well, we remember back during COVID, I think there was 1 year in there where the government allowed us to take $600, I think is what it was. Well, that's back, right? You can take it above the line, if you will, not, if your standard deduction, you can take $1,000 for cash gifts. However, if you're itemizing, now you must hit a 0.5% AGI floor and are subject to a new 35% cap on all your itemized deductions. A little confusing there, but just know that if you give cash to charities this year, no matter whether you itemize or you're in the standard deductions, you should be able to get something. One exciting part for us was the estate and gift tax exemption. That was set permanent at 15 million, indexed for inflation. Great news. Many of us will never have to worry about having to pay additional tax upon our passing of our assets to our heirs. The no tax on tips and overtime was really cool to try to process this year. I say cool. The rules went into place, and a lot of folks who did get overtime or were paid tips. So it was kind of nice to see that there was no tax being paid on that. A lot of those did not show up on the W-2s last year, but they will be showing up on the W-2s this year. The government gave you an extra year to get the provision in place for employers to report that for us. So a little easier getting that in next year. And I would say for more additional advice and tax tips, reach out to us. It's part of all the financial planning we do for all of our clients. Discuss your unique situation. As always, we work with you to maximize your financial plan by providing strategies to save tax, build wealth, leave a legacy. With that, wanted to point out our social media. This is really just to our YouTube. You can find our other social medias out there. You can just Google McCabe Gunn, it'll pop up, or Gunn & Company Investment Management for our affiliated firm. But speaking of advice and tips, we'd like to invite you to navigate to our YouTube channel. If you have your cell phone out, you can scan that QR code. Go ahead and subscribe on that channel. And the reason I would like you to do that is it's the easiest way to watch or rewatch these quarterly economic presentations that we do. And also, Marshall and I, when things get a bit tumultuous or sketchy, if you will, we'll put out a quick 5 or 10 minute video or less, depending on the scenario. We pop that on our YouTube channel. We usually do email everybody, but if you subscribe to that channel, you'll have that. Don't worry, we're not monetized. We're not looking for subscribers. We're just trying to get information out to everybody. So, all right, Marshall, I think that's a good break from the heavy economic stuff. Let's flip it back over to interest rates.
All right. Interest rates have not changed very much. We're still looking at a 10-year treasury yielding about 4.416. That's after the meeting yesterday. So that is, of course, a critical driver of U.S. borrowing cost. It continues to waffle. And as I say, it rose slightly after the Fed press release yesterday that they were holding things steady, but listening to the press conference, and you saw a slight move upward. Remember, the key driver of that rate is economic uncertainty, which, as we've expressed earlier in the presentation, there's no question. We've got plenty of that going on, and rate cuts from the Fed. We don't see any significant change in the rate cuts, as Shawn saw on the dot plot chart of where the Fed governors are, what they're thinking. So we just don't see any significant changes in the near term. I know that's very disappointing to some of our attendees this morning who are in the real estate and construction world. So sorry, I don't have good news to report there. Home prices and mortgage rates declined slightly over the year, but it's still, it's minuscule. It's down past the decimal point. Activity's nowhere as it has been in recent years. We've created somewhat of a K economy, and that at the high end of real estate, you're still seeing activity. Those are generally not financed, they're cash purchases, but in the bread and butter financing world, it's very, very challenged at this moment. And it will continue. This is my best call at this point. The 30-year mortgage has continued to waffle slightly, but still hasn't made a defining move in either direction. And like the 10-year rate, it's all about uncertainty and cuts from the Feds. Continuing on that, Shawn, that really wasn't a lot to report on interest rates because of the steadiness of it, but bring us about in investing in our current economic times.
Absolutely. And as always, we're not talking individual and specific investments, but we do talk markets, we do talk sectors. And I just want to repeat the caveat that the following things we're talking about are not recommendations to buy or sell. They are presented for informational, educational purposes only. With that being said, there is always, and there will always be, reasons to sell your portfolio, or put differently, not buy. Market's a scary place. And so far, the 2020s, we'll just focus on this decade, have given us plenty. COVID-19, political scandals, tariffs, wars, presidential assassination attempts, global conflict, AI, tech threats, right to jobs, et cetera, et cetera, et cetera. There will always be something, some bad news out there. And I always like to just give it a perspective. This chart's pretty cool. I know there's a lot of data on it, really hard to read on a small computer screen. But I kind of like it that way because we're looking at the bigger picture. And the reason that's important, because if you zoom in, if you stay zoomed in on the shorter term and you focus on all the volatility, you see all the reasons the market goes down, right? You'll miss the bigger picture. What do they say? You get lost in the forest amongst all the trees. That's so true. And the reality is the markets tend to be up 75% of the time. Therefore, if you stay zoomed in, or excuse me, you stay zoomed out and look at the longer term trends, you'll notice the major crises of the day that seem so different this time, so world changing, really was not a big deal in the grand scheme of things. The Iran conflict, it will be no different. Case in point, this chart is one of my favorites, I should say. And it gives you a perspective of volatility in kind of what's going on in the world. And the red dots on this chart indicate an intra-year low, meaning the low point of the S&P during that year. The black bars, I think they're black, maybe dark gray, indicate how the market finished for that year. So just take a quick look at that and just kind of generalize it. Don't read all the numbers. Just look at the dots and the bars and go, okay, I think I see it. You'll notice every year at some point was at a loss. At some point, the S&P was negative for the year. Only 11 years out of the last 46 years did the market finish at a loss. It finished down at 11 out of 46. Never in the last 46 years, and we're not allowed to use that term. Very rarely can we, unless it's absolutely 100% true. Never in the last 46 years have we ended a year at the lowest. So flipping to the next slide, like, what do you do with this, right? Marshall and I show this all the time. We're not alone in this. A lot of finance folks around the world use these charts all the time. They kind of just get people to look at this and go, all right, stay focused on the bigger picture. What should you do? Number one, as we talked, as we opened up, as Marshall said, as I said, ignore the noise. Turn off CNN, turn off Fox. Their job is to get you locked in the watch, and the only thing that does that is watching train wrecks, bad news. Okay. And as we talked about in the 2 slides ago, if you focus on the negative, you're going to miss the bigger picture that everything's going up, and it has been for years. Number 2, stay invested. If you looked at 2 charts ago, and I don't want you to switch back, Marshall, just to talk about it for a second. If you started investing 20 years ago and you looked at it today, do you really care where it was in the beginning? No. So stay invested. Don't try to time the market. It doesn't work. It's a fool's errand. And last thing is stick to the fundamentals. We always present this Callan periodic table, which just shows the mix of the different sectors in the market. This one highlights with the white squares what a diversified portfolio looks like. It's right in the middle, and it kind of stays in the middle. And the reason that's important, and we say this all the time, investing isn't about getting rich and getting wealthy. It's about building wealth that helps you achieve financial independence. And that means you want a portfolio, you want your investments as stable as you can get it, right? Reducing your risk while maximizing the return, but getting an average return that you can plan on, that you can rely on, that you know over time you're going to get. That way you start today, you plan for the future, you will have a big enough pile, enough money to be financially independent. That's the key to building wealth. So stick to the fundamentals, allocation and diversification. A lot of folks, and I'm going to point one thing out on this chart, Marshall, and I'll turn it over to you. I think we got a little time here. The very top right dark green box, that column is for 26. I believe that's commodities. And this year, it's the most best performing index. Okay. And what most people will do go, oh God, the gold's doing great. Gold's safe. It's a safe place to go, or commodities, to roll them all together. And I'm going to put my money there because it's doing well right now. And I don't know what's going on in the market, and I'm just going to get out. I want to go to gold. I want to go to gold. They've done well. But if you look back at that dark green box, commodities, look where it's performed compared to everything else in this chart. It's at the very, very, very bottom. Everything else is outperformed it. Not everything, not all the time. I have to be careful with those types of words. But for the majority of times, commodities have way underperformed everything else. So be careful. Don't buy into it. You'll start seeing a lot of gold and ETF commercials on CNBC. There's a reason for it. They want you to buy the hype. They want you to buy their ETF. Those ETFs or those mutual funds are very, very, very expensive. Okay, I'll get off my soapbox. Marshall, anything to add to that before we turn it over?
We've got a question on cryptocurrency, which I think goes in here as uh, changing interest rates are involved. And I think cryptocurrency gets a little bit into that commodity sector
Mm,
or alternative investments. And, you know, cryptocurrency gets a lot of press.
it does.
But in reality, the value of the cryptocurrency compared to the global economy is only 0.2%. So, in from an accounting standpoint, if we're rounding, it doesn't even get rounded into the global economy, but it gets pressed like crazy. And yes, we've all heard the stories of someone who bought the cryptocurrency, did phenomenally well. Uh, but Shawn, you and I do the tax returns for people who have bought cryptocurrency, and I'll put you on the spot and bait your question just a little bit. How many of our clients paid taxes on big cryptocurrency gains this year?
Oh man, I haven't seen one yet, to be honest with you. All those cooped up capital losses will be used years and years ahead.
And that's pretty much what I've seen. So, from the
Yeah,
small investor standpoint, it has not had a dramatic impact. And the
yeah,
question is actually about the impact on interest rates and global economy holding debt. Um, the US dollar is still the standard basically for the world. And the US interest rates drive so many things. So I
yeah.
just don't see that having quite the impact that the press likes to
Yeah.
think for us.
Well, may I touch on that
Um,
too, Marshall, real quick, for the cryptocurrency central bank digital currency with central banks bringing cryptocurrency in, how that'll affect rates globally. I think what you said is the right thing, right? If the U.S. is not going to adopt it, while some world economies are adopting it, it's not going to be a global player as far as a store of value for government use. That being said, the last things I've seen, the U.S. has actually turned away from that program and wants to continue privatizing it. So unless unless the U.S. adopts the central bank digital currency, which they're not going to, I wouldn't have any concern about it, Alicia. But great question.
yeah, and there was a follow up that just popped in the chat box on Federal Reserve changing
There,
from the dollar to cryptocurrency.
yeah,
Sean, I think
yeah.
I agree with you. Ain't happening in anybody's lifetime on this screen, probably.
I don't think so. So great question.
Absolutely. And the press is giving us that bait constantly, but you have to drill it down to the reality of what is the actual impact on the world economy, and it doesn't even get to blip the screen, but it gets a lot of press.
That's right.
Sean, I'm going to ask you to help me field a couple of questions that were sent in.
Okay.
Amy and Brandon asks, shouldn't we be moving more of our investments into gold or silver?
Well, I think I answered that one. Please don't. I think just from a human standpoint, I understand, I get it. The gold and silver's been doing great. We know a lot of people who have bought it a while ago who show a gain on it, made some money. But it's a terrible move, in my opinion, for your overall plan. Gold's at a high. You're going to buy it, and when gold goes down, you're going to be upset with yourself, right? So just don't buy gold right now. It's not a good alternative for your portfolio. I would say that if you're going to buy gold, then it's best for your safe, couple grand in there for store value, or even more importantly, beans and bullets, as Marshall and I were joking about the other day. I hope that answers it for you.
That helps, Sean. Which kind of leads into as well the next one. I'll cover this because I'm the old guy. What would be your guess on the future of Social Security?
Ah,
Social Security, as everyone knows, the Social Security Trust Fund is about to go bankrupt, or the statistics are that it's going to get the changeover, if you will, that the trust fund's scheduled to run out of money based on its current payments. So as a result of that, um, what you're seeing is that if it does run dry, there'll just be another tax. If you had every Social Security recipient in the United States suddenly had their check not appear or to be reduced, the dramatic impact on the economy would be devastating. So the reality is the federal government will find another way to find the money. And that comes from the two sources that the federal government has to fund everything else they do right now, where they don't have the money. And when you don't have the money, you either raise taxes to get the money, or B, you print money and lend money. And that's in the form of treasuries. And as long as someone is out there, if you will, who will buy the US Treasury notes, bonds, bills, they will continue to print it. It may cost us at a higher interest rate, but it'll just be another tax to fund that. I hate using this word, entitlement, but that's really what it's deemed at. Speaking of payments, a question came in about what about low risk dividend stocks? Which ones are we recommending? Well, avoiding any specific names, certain dividends from domestic companies receive favorable tax treatment. There is a place for lower risk dividends in your dividend payers in your portfolios. Generally, you find these companies in the Dow. These are the old stodgy members of the economy who pay, nice dividend rates. And by nice, I'm saying in hovering right now in that 3% range. They have a history of increasing their dividends annually and provide a product that consumers purchase in good economies and bad. And I alluded to that a little bit earlier in the conversation that we've had today. Shawn, any of the other questions that have been posted you wanted to grab, or you want me to grab?
I was actually just going to type Alicia back. The Federal Reserve, she mentioned that they are reviewing change in digital currency, and you are correct, Alicia. They are. They always have been. They've been looking at, should we implement this? They have not made that decision yet. But I want you to look at, when you get a chance, the Anti-CBDC Surveillance State Act. There's a bill going through Congress to prevent the Federal Reserve from having that broad authority to issue digital currency as a CBDC. So just check that out. In reality, though, Alicia, the truth is, yeah, the government could change their mind. They could implement that. We just don't foresee that coming. And just applying kind of a nominally, that's not the right word, but just looking at it from the standpoint that if the government can't manipulate it, inflate it, print it, I don't think they're gonna use it. And until they figure that out, or until there's a way to do what they can do with the currency that we have now, they're not going to implement it. This is the way it works. Another question Bill had, let's see. Oh, Bill said, what's our view on the Federal Reserve being abolished like the Department of Education? I love that question. Marshall, you want to answer that one?
Not happening. Keep in mind, they're two different worlds.
Yeah.
But the Federal Reserve technically works independently and is designed for such. And, you go back, we can talk about going back to the Jekyll Island and all of the things that create the Federal Reserve. And they're two different worlds from what they do. And getting that abolished through Congress, I think, would not happen. It's great fear press from the mainstream media, but the reality of what they do and the things that they do have to be done at the federal level, almost at the world level. And the world looks to the Federal Reserve of the US to make certain economic decisions because of the global impact. So believe me, yesterday at 2:30, all eyes were on exiting Chair Powell and listening to him in the financial world, whether you're US or European or any other economy. I will address the question on Medicaid annuities. Make sure, Shawn, did you say something?
No, go ahead. Sorry.
Okay, good. On Medicaid annuities, keep in mind there's Medicare and Medicaid. Medicaid is when you're financially not very well off, I guess is the best way to describe it. And so if you had someone, or maybe you, that you wanted to deplete your assets so that you could qualify for Medicaid, either from a retirement standpoint or from a healthcare standpoint, there are certain annuities out there that you can set up that qualify under Medicaid. This is a very fine area of financial planning that we do periodically. But for the bulk of our viewers that are on today, you're my financial planning clients, and I can almost say you'll never qualify for Medicaid because of the dollars that you have accumulated during your working and earning years. So if anyone would like to speak to that individually, I'll be glad to address it. But as a group, this group probably is not Medicaid rather qualified.
Yeah, and I'll throw out a caveat to that, or an addition. A lot of folks are trying to get qualified for Medicaid that shouldn't be, right? And sometimes you hear these annuities or type things that are protected from Medicaid, but there's a lot of law that goes into that, and very, how can I say this? Very risky if you're trying to do it just to avoid Medicaid and you're really close to the situation of needing Medicaid. So I'll leave it at that. Like Marshall said, it's very intense planning, involves lawyers, involves planning ahead at least 5 years, I would say. So just be very, very careful. And if you get into a specific situation where you're actually considering it, bring it in. Let's sit down and talk about it.
Absolutely. Thank you, Shawn. Appreciate you following up on that. Any additional questions? I think we've hit everything in the chat box. Shawn, did I miss anything?
No, sir. It looks good.
I do want to touch one more thing on digital currency and how we are seeing the IRS move to digital situation and the banks moving to be more digital. This was the first tax year where the IRS was not issuing paper check refunds. They came out with that mandate last fall. And we saw some changes in the way we had to practice with our clients because they're trying to digitally track money. And for years, we've heard about the underground or the cash economy. And so there is a strong move to overcome that. And I could get into all the social and political reasons on that, but just generally say that there is a push in that direction, not for a digital currency, but a digitally documented use of the current currency. So, well, covered a lot. Thank you so much for the chat questions and your pre-questions. To close, I'll recap. Always build your investment portfolio on companies whose profits are not tied to politics. Regardless of what happens in the economy or who is in the White House or Congress, people will continue using Charmin. I hear they need a lot of that in DC. They're going to keep eating, taking their drugs, and using their cell phone. So please remember to follow us on social media, scan the QR code, and you'll be linked to so many of our resources. To finally close, if you know someone who will benefit from our webinar, we'll be offering a recording of today's presentation on the McCabe Gunn YouTube channel. Once it's posted, we will email a link to all registrants. As always, feel free to share it with your friends and family. As Shawn alluded to, we don't do this for numbers. We're still about 100,000 followers short of really getting any big money from YouTube, that's for sure. Any final questions before we wrap up? I didn't see any more pop into the chat box. So our next scheduled event will be our Q2 economic update. It'll be held Thursday, July 30th at 10 a.m. Thank you so much for joining us. We look forward to meeting with you soon to cover any of your specific questions, and we just appreciate you more than we could ever express. Have a wonderful day. Stay safe.